Thanks for joining us today on Market Call. I'm Morella Fernandez. Stan Wong with us on the show. He's portfolio manager at Scotia Wealth Management. He'll take your questions on North American large caps and ETFs. Here is how to reach us today. If you'd like to call in, 1-855-326-6266. Email your questions, marketcall@bnnbloomberg.ca. Stan, good to see you. Thanks for coming in.
It's great to be here. Thank you.
North American markets dragging in the red today after that high by the TSX just yesterday. It looks like there's concerns about the government in Washington reopening, but what data is going to be produced. Do you think investors are rightly concerned about labor and inflation data in the U.S.?
Well, certainly there's going to be a little gap in data given the government shutdown. But honestly, I think that there's positives that overcome the negatives for markets. I mean, I think equity markets, despite the volatility that we've seen so far in November, they remain pretty well supported by earnings, number one, liquidity, number two, and seasonal trends, number three. If you look at earnings season so far in Q3, the S&P 500 constituents, 80% have beaten expectations thus far. You look ahead to 2026, we're seeing at about a 13% earnings growth rate projection. And then we look at liquidity and dry powder. There's about $7.5 trillion US. That's a record number in money market assets sitting in the United States. And as you know, seasonality, fourth quarter is your best quarter to be in.
It usually is, but what do you think investors are concerned about? Because there is that volatility, as you mentioned, traditionally at a time that's not volatile.
You know, what aren't investors concerned about? Lately we've been talking a little bit about the potential of a bubble in the AI space and technology space. I think that's very premature. I was around in 1999 and 2000. We don't have the same conditions as we did back then. I think the concern really is, are we kind of too far too fast? And markets have really taken off since April, May. And then you look at the potential for volatility with the midterm elections next year.
Okay, let's talk also about the fact that there's a major announcement by the Prime Minister today. Do you think there will be enough enthusiasm from this announcement, or is this already worked in to what we're seeing in the markets?
Well, I mean, I think that there's some softness in the Canadian economy, and I think that that's expected for the next couple of quarters. I believe that investors are really going to refocus on monetary policy. At least in the U.S., we see another strong case for a 25 basis cut by the U.S. Federal Reserve in December.
And you guys are saying that now, but again, we don't have the data information, so that could change depending on what comes out?
It could, based on futures markets, we're looking at about a 60-70% chance of a cut in December at this point.
Got it. Okay, let's line up some phone calls and some emails for Stan Wong of Scotia Wealth Management. Again, he's taking your questions on North American large caps as well as ETFs. Here's how to reach us today. Back in a moment. Welcome back to Market Call. We're going to start with an email from Bob. He says, is Pinterest, PINS, P-I-N-S, on the New York Stock Exchange, a buy, a sell, or a hold? Pinterest has trended down pretty much most of the fall, sitting at $27.23. It had gotten up to $40 flat, I guess, in February or earlier part of the year. Let me have a look here. In February. So any idea of what's going on with the company? Is this something you would sell at this point at a low point?
Yeah, if you look at the chart, I mean, really, we're seeing a pretty flat move, sideways channel since mid-2022. The 200-day moving average is very flat. The price is below that 200-day moving average. I don't think valuation is really a concern. It's trading about 14 times forward earnings with about a 10 to 15% growth rate. So valuation is not the concern. I think what's happening is that you look at the news, management provided a weak holiday sales forecast, which has hurt the stock, and there's a bit of a slowdown in North America. So this focus on the international markets, or this forced focus on international markets, is not being great because there's weaker margins in international markets. And then you're seeing advertising prices on Pinterest fall as well. So it's getting hit by a few different sides. In this particular space, it's not one of my names that I would consider. We don't own it in the portfolio. If you're looking at this communication/technology area, I'd look elsewhere.
Okay. Let's move on to our first caller then. Chris is in Delta, BC with a question. Hi, Chris.
Oh, good morning, Morella. Stan, nice to see you back on the show. Sam, I know in the past you've recommended a few times. I don't think it's been a very many times you've recommended LVMH, but it's had a pretty good recovery. And I'm wondering, in terms of the Chinese economy and their markets and the overall world economy, is this a stock that at this time you would be taking profits on, holding, possibly adding? I'd really appreciate your thoughts. Thank you both.
Okay, thank you for the question. So luxury goods kind of group, Louis Vuitton, they do cognac, perfumes, cosmetics. We talked before about the fact that the consumer, the high-end consumer, is still buying, but the lower-end consumer maybe isn't as much. Have things changed?
I think the story behind this stock, and we don't own this name in the portfolio, I think long-term it could be a name that we would reconsider adding back to the portfolio. The story really has been a wait-and-see game with China. That economy did not bounce back as quickly as we expected after COVID, and that's been the case. More recently, the fashion unit within LVMH has performed a bit better, and that's why the stock price has moved somewhat higher. Technically speaking, we're seeing some positive signs in the fact that the price has moved above the 200-day moving average, yet that 200-day moving average is still trending lower or flat. So we're not in this name right now. I think I would wait to add to this name or to, purchase a new position in this name. Really in this space, what's happened is that more the mid-tier players such as Tapestry, which owns Coach, and Kate Spade has performed very well. Whereas LVMH and Kering, which owns Gucci, has really not performed so well.
Got it. Okay, I hope that is good for Chris. Let's move on to Nicole, who's in Montreal with a question. Hi, Nicole.
Hi, guys. Hope you're having a good day. Stan, I bought Expedia a couple of years ago in the low 80s, and I'm just wondering if I should take my profit or hold on. Have a great day, both of you. Thanks.
Thank you. We'll pull up Expedia's line chart in just a moment, see where it's at today. So she bought in the 80s for Expedia. How's the company doing?
So Expedia is actually a name in our portfolio. I've actually highlighted it in the last couple of segments with Market Call. Continue like the name. You're paying 15 times forward earnings, 15, 16 times forward earnings, and you're getting a 20, 21% growth rate. So from a PEG ratio perspective, I think you're getting very good value there. Stock price is performing very well. The chart looks attractive, other than the fact that it's quite overbought. As you can see on the charts, it's really just sort of jumped up more recently. We actually pared back a little bit just because it got to be a big part of the portfolio. So we took a little bit of profits in this name. The reason why the stock's performing well is that they just increased their full year outlook, and the stock has responded, obviously. I think midterm and long term, this name can continue to perform well in that there's more travel happening. When you look at travel around the world, it's continuing to increase, especially in the leisure side of things. With the way people work today, they can work remotely anywhere. There's opportunities for people to work anywhere in the world. So that's spurring some travel through the Expedia site or booking or whatnot. So I like this name long term, and demographically it makes sense.
What made you trim? Because she's asking that same question. Having bought in a few years ago now at 271.30 today, she's wondering if she should trim as well.
A couple of reasons. I mean, it's very, very overbought at this point, especially given this last surge. And we have certain parameters in which just one single position can't really be beyond a maximum weighting that I want to see in the portfolio.
Got it. Okay. Let's move on to Sam then. He's in Toronto with this question. Hi, Sam.
Hi. You recommended SVR a couple of months ago, and I bought it at 16 something, and it gone to 23, and it came back to 21 or something. I sold it. I thought roll is going down. Now I see it's gone up a little bit. Do you think you have more room to go up? I'll appreciate a comment. Thank you.
Thank you. So sorry. This is the iShares Silver 2480 is where it's sitting today. Is this something you like, this ETF?
Yeah, we hold this ETF in our portfolio, and I would say that having a little bit of silver or gold in your portfolio makes sense, just given the changing policy in the United States. A lot of people talk about gold, but if you look at silver, it's outperformed gold by a fair margin this year alone. Silver is up 83%, gold's up 60%. So
Do you tend to hold both?
we have silver in our portfolio.
Okay.
And I like the silver bullion. I think the ratio of gold price to silver price is really overextended now. And if it just reverts back to the median or the mean, I think that silver prices will do well. Either gold prices will come down and silver goes up, or they both kind of revert down. But I think right now there's a lot of attention around precious metals, and silver is our choice.
Would you buy in at the point it's at today?
I would. I would continue to hold it. Certainly, I don't want you to get too excited or have people get too excited about silver and gold. I mean, silver and gold tend to have very long periods in which they perform very poorly or don't perform at all.
Yes.
So have it as a percentage of the portfolio, 5%, something along those lines.
All right. We're going to take another quick break. We will line up more of your phone calls for Stan Wong of Scotia Wealth Management. Again, he's taking your questions on North American large caps and ETFs. Back in a moment. Welcome back. Thanks for joining us here on Market Call. Let's go right to the phone lines. Don is on the line. He's in Vancouver. Hi, Don.
Hello. Yes, my question for Stan is on ITA, the U.S. Aerospace and Defense ETA, or its equivalent in Toronto is XAD. I'm thinking about initiating a position. It's run up quite a bit lately. It's a bit of a crowded trade, as everybody knows, I think, but I'm wondering if it's rolled over a little bit just lately. So does this represent a chance to get in? What are Stan's thoughts on that? And would he buy it in Toronto if he does like the sector?
Okay, thank you for the question. Go ahead, Stan.
We don't own this particular ETF in our portfolio. We have other industrial names, but this particular ETF will own some of the top ones would be General Electric, RTX, which used to be Raytheon, Boeing, and L3, General Dynamics, and so forth. I think when you look at the landscape around the world, there's more and more attention to the aerospace and defense area, most certainly. So that is why this particular name is performing the way it has been. It has a great chart. I mean, the chart looks great. Ascending channel of higher highs and higher lows. The the ETF price is up about 45% year to date. And 36% over the last 12 months. So certainly a strong performer. I think it's just a bit of a narrow space for me in our portfolios in that it's really just more of an industry rather than a sector. It has sold off a bit. The RSI is about 42. So if you're looking to move into it, it's not overbought at this point. So certainly you can add a position. But again, it's a very specific area. I'd be cautious to how much you allocate to this space.
Okay. Don, I hope that's good for you. Let's go to Tony, who's in Conception Bay, south in Newfoundland. Hi, Tony.
Yeah, hi. Stan, I'd like your opinion on North American REIT, long-term hold for dividend and dividend growth. And not really for right now, but when the market pulls back potentially, 10, 15, 20%. Thank you.
Okay, so a suggestion in REITs for Stan. Tony from Stan.
Yeah, so we don't have any REITs in the portfolio at this point. I think if we were to look for REITs, we'd probably look south of the border, and I'd look for those storage and logistics types of spaces and those data centers. I think that when you look at those areas, those are a growing area. Everywhere you turn, there's a new storage center that's there, and then data center REITs would make sense as well. Logistic spaces, there's more and more warehouses because we're all ordering things online. So Prologix would be one name that pops to my mind. I think in Canada, if that's what the caller is calling about, we want to be careful in terms of the retail REITs like RioCan, just given the bit of a softness that we're seeing in the Canadian economy.
So you worry about consumer spending?
I think so. You look at Q2, I mean, we had a negative GDP number. And the consumer stretch, inflation, cumulative effects of inflation since COVID has been impactful as well. So if you're looking at REITs, I look at the U.S., probably stay away from the Canadian REITs at this stage, especially in that retail space.
Okay. Let's move on to Elliot, who's in Hamilton today with a question. Hi, Elliot. Elliot, are you there? Okay, we may have lost Elliot. Can we go to Bill in Sioux Lookout with a question in Ontario. Hi, Val.
Hello.
Hi. What's your question today?
Oh, this is Elliot.
Oh, hi, Elliot. We were waiting for you to answer.
Anyway,
What's your question today?
Please, reporting softness in two of its smaller segments, recycling and health services. Waste management took a big hit from the 240s down to the 190s. Would you pick it up here, or would perhaps you prefer its Canadian cousin, WCN? Thank you.
Okay, thank you for the question. Let's pull up the chart for waste management and have a look. Is this a stock that you follow?
We follow it, and we actually own both Waste Management and Waste Connections as more the defensive parts in our portfolio. I think that when you look at industries that have very reliable earnings and revenue, it's definitely Waste Management is one of them. The garbage and the recycling is always picked up every single
going
week,
away, yes.
or every other week, depending on where you are.
All the packages we've been ordering. Okay.
Absolutely. And if you look at Waste Management, although the stock has fallen below the 200-day moving average, it is looking to be bouncing off that $200 support, which it's hit several times in the past couple of years. If you pull up a long-term chart, you'll kind of see that. So I think that you're getting a name where you're getting a pretty reliable earnings growth rate at about 10%. You're paying about a 25 times PE ratio forward, which is not cheap. But again, there's only so many players in this space. So we really like companies that are in very limited competition type of situations or industries that have only few competitors. So I do like Waste Management. It's not as exciting as Meta Platforms or Netflix or anything like that, but it has a place in your portfolio.
Okay. And do you find people are turning to more defensive stocks these days?
I wouldn't say perhaps in the last few days or last week or so, given the fact that the market in the higher beta stocks or higher growth companies have come down a little bit. We see the Dow the Dow is still actually at month to date at a positive, whereas the NASDAQ is at a negative. So, and that's why it's important to have both areas, because they'll offset each other when markets go one way or the other.
Okay. I hope that is good for Elliot. Let's go to Vil, who's in Sioux Lookout in Ontario. Hi, Vil.
Hi.
Go ahead.
I own Oracle, but it's been dropping last couple of days quite a bit. Should I hang on to it or sell it? Thank you.
Thank you for the question. So Oracle, under, I guess, the tech stocks, generally speaking, have been tracking down. Let's pull up that chart. There we go. So it's down 3.5% just today, losing $7.89 to $2.19. What's your take on Oracle?
Oracle has done very well. I mean, if you look back at September, October, the stock really surged based on the fact that their cloud contracts were very, some of their cloud contract wins were strong. The stock's really just sort of reverting back down to the 200-day moving average, which is just above right now. So if you're a holder of Oracle, I wouldn't sell it here, because I think it might bounce off that 200-day. And plus, the tech market's having a little bit of trouble this week. It's challenged this week. So I think you don't want to be selling at weakness. The relative strength right now, index for our Oracle is oversold at 26%. So not a time which I would say you wouldn't want to sell this stock. We don't own Oracle. We have some other tech and communication names in the portfolio, but Oracle is going to grow at around 15 to 18% earnings growth rate. You're paying about 30 times, so it's not cheap, but it's not expensive like some of the fringe type of names in the tech space.
Okay, so hang on to that. We're going to take a quick break. We'll have a look at past picks from Stan when we come back. Back in a moment. Welcome back. Time to have a look at Stan Wong's past picks from November 7th of 2024, so just over a year ago. At the time, he chose Caterpillar, CAT, on the New York Stock Exchange at $408.21 US, up to $574.50 today, so a 41% upside return and a 42% total return. What did you see in Caterpillar back then, or was this a stock you're already holding?
With Caterpillar, I just wanted to be in a more cyclical space. So this is one of the most cyclical industrial names out there. We no longer hold the stock. We took profits on the name, just based on the fact that it got a little bit expensive based on historical average and peer group. It's trading at 28 times forward earnings with about a 11% earnings growth rate. So a bit pricey for me at this point. Certainly a name that if it pulls back enough, we'd look at it. What's interesting about this name is that it's performing well, partly because of data center expansion, equipment needs to build more data centers. So, to associate Caterpillar with this AI boom and this technology growth boom is very interesting at this stage. But with that being said, I think it's a bit expensive. So that's why we're out of the name. We took our profits.
Yeah, and I think they also lease as well as options to own. So companies can obviously just lease, and that's recurring money for this company.
That's right.
They do pretty well. Okay, let's get to your next past pick, which was Netflix, NFLX on the NASDAQ. At 796.54 US at the time, so a year ago. And now it's up to 1,157.40. So 45% upside return, 45% total return is the same. Netflix just keeps going and going. Did you take some profit from this, or are you hanging on to it?
Still hanging on to it. You're getting a 25% plus earnings growth company. You're paying about 35 times forward earnings, and I think that's not a bad PEG ratio to consider. There are now over 300 million global subscribers around the world in 190 countries. You talk about the original films that they're able to create, the series, the live events that they're now getting more and more into, whether or not that's professional wrestling or football or other sports. It's really driving more engagement, driving more subscriber growth, which gives them more revenue to create more content and more localized content across different regions that they're trying to expand into. Unlike other streaming services whereby the content is relatively limited, such as a Disney Plus, I think Netflix is really the clear leader in this space. So I like this name, and it continues to impress. Okay,
Netflix is your second pick. Let's get to your third, which is iShares Core S&P Midcap ETF. It was at 65.61 when you recommended it. Now it's about the same, 65.33 US. So not a lot of drop return, total return of under 1%. Tell us a little bit more, first of all, about the ETF and what's included in it.
So this is basically the S&P 400 Midcap Index. So you're going to see names that you won't see in the S&P 500, whether that's Williams-Sonoma and those types of names. I like it, and we purchased it because it is much cheaper than the S&P 500. Large cap names, and historically mid caps tend to perform better over long periods of time over the S&P 500. That hasn't happened in the past year or so because all the attention is on the mega caps, the S&P 500 top 10, the Magnificent Seven. Mid caps tend to be more leveraged to economic growth in the United States. So as long as that economic growth continues, I think that the mid caps can recover and put some performance on the board. The expense ratio for this ETF is only 5 basis points. And again, it's important to be diversified, not have everything or 50% of your portfolio in mega caps.
So you're hanging on to this one, is what
we
it sounds
still
like.
hold it, yes.
Okay, good to know. So that was the iShares Core S&P Midcap ETF. We're going to take another quick break. We'll line up more phone calls for Stan Wong, Scotia Wealth Management. Your questions today on North American large cap and ETFs. Back in a moment. Welcome back. We have Stan Wong here answering your questions. Let's go to Alan. He's on the line in Montreal. Hi, Alan.
Yeah, hi. Thank you very much for taking my call. I'd like to ask Stan his opinion on the Canadian ETF, which he likes better between VDY and XIC, or if there's any other one that he prefers.
Okay, thank you for the question. Pulling up the Vanguard line first, which is at, I have 59.64. Do you know this Vanguard ETF pretty well?
I do. It's basically a basket of high dividend paying stocks. The only thing I would say about this, Canadian stocks, the only thing I would say about this is that it's very heavy in banks. It's about 46% in Canadian banks. So depending on your outlook on Canadian banks, you want to be certain whether or not this holding makes sense for you. you're getting about a 4% dividend yield in this particular ETF. So, it's about 3.3% dividend in this ETF. The underlying is about 4, but of course there's management fees involved. It's done very, very well, up about 25% in the last year or so. And I think the caller was asking about XIC, which is also it's not a dividend play necessarily. It's basically the TSX index, not necessarily a dividend. So it's going to be much more diversified because it has all the different sectors, not necessarily just high dividend names, but obviously a lower dividend. There's about 21% banks in here. So, of course, more diversified type of name.
Between the two?
Yeah, it really depends on the investor. If you're looking for yield, then obviously VDY will pay you that 340 dividend yield. XIC is going to pay you about a 230 dividend yield. So if you're looking for yield, then you go for VDY. If you're looking for more diversification and not necessarily yield, then you go for XIC.
Okay. Let's move on then to Walter, who's calling from Ottawa today. Hi, Walter.
Hi there. Question is on Canadian natural resources. It's stuck in a real tight trading range, and I'm tempted to buy, but something tells me to wait. And I'm wondering what your opinion is. Would you buy at this price, or do you think there'll be a better entry point? Thank you.
Okay, thank you for the question. CNQ has been pretty sort of range-bound. Price of oil has been fairly depressed. What's your outlook for a company like CNQ?
I don't have any energy names specifically in our portfolio. I'm very, very neutral in the space. As you can tell with CNQ, the price has really been quite sideways for some time. The 200-day moving average is actually trending a little bit lower, so not a great technical sign. And really, the stock's been a sideways movement since 2022. The only name in the energy space that's performed well is Cenovus, CVE. We don't own that either. However, that's a name that, from a momentum and a charting perspective, looks a little bit better. Of course, you're getting a very nice dividend with CNQ. You're getting about a 5% gross dividend yield, which is good. I don't think that dividend yield is at risk at all. So if you're looking for the yield, that's good. That might be appropriate, but I don't know if there is major capital appreciation for me ahead in the next 12 to 18 months.
Okay, Michael, I hope that helps you make a decision. We are going to go to, sorry, that was Walter. We're going to Michael now. He's in Vancouver. Hi, Michael.
Marilla, Stan, thanks so much for taking my call. Stan, in the past, I think you've selected XEI as your high dividend Canadian ETF choice. I wonder if you have a U.S. dividend that also is as low MER and that is similar to the XEI in Canada. And if I could just ask a follow-up question, Stan, is it full speed ahead for your clients, or with this robust market that we've had over the last 36 months, are you asking them to exercise a little bit of caution? Thanks, folks. Have yourselves a great day. I'll hang up and listen to your response.
Thank you for the question. So let's start with the ETF question. On the U.S. side, is there one you like?
One that I like but we don't necessarily hold right now is HDV, the iShares Core High Dividend ETF. It holds names like ExxonMobil, Johnson & Johnson, AbbVie, Procter & Gamble, Merck, and so forth. So very, very steady type of dividend paying type of strategy. You're getting about a 3% dividend yield, not necessarily a growth-oriented one because it doesn't have those mega cap technology names necessarily in there. But that's a place to start. Vanguard will have some ETFs that are good too. I think VGG or VIG is another name that I would consider. VIG is the Vanguard Dividend Appreciation ETF. So not necessarily high dividends, but companies that have a history of increasing their dividends, which is very, very important in our analysis as well. And this ETF has actually performed quite nicely, a little bit better than actually HDV in the past little while, because it holds names that are not necessarily just high dividend names, but companies that can or have been appreciating their dividends over some time. And I think the second part question was, what are we doing?
Yes, asking investors to be cautious, I guess, at this time.
Yeah, so, the bull market's 37 months old at this point, and the average bull market is 67 months old. Some bull markets are shorter, some bull markets are longer. I would say that with interest rates falling, with the amount of liquidity in money market assets in the U.S., with the fact that the S&P 500 is forecasted to grow at 13% next year, inflation is under check at this point, or in check, I should say, at this point. Unemployment numbers in the U.S. are steady, softening a little bit, but that just allows for more interest rate declines or interest rate movements downwards. I'm still very constructive on the markets. Whether or not we are oversold in the very near term, we certainly had been given the move since April. But look, 75% of the years the markets are going higher. You don't want to be high in cash for long periods of time.
Okay, you don't want to be missing out on that.
That's right.
Got it. Okay. Let's get to a quick email before the break. Fred has written in what's going on at Shopify is a question. I haven't looked at Shopify in the last day or two, but we'll look at it now. And this is a stock that does tend to be volatile, so no surprise for the ups and downs here. But is this a stock you like moving forward?
I don't own Shopify in our portfolios. I don't think I've ever had Shopify. I tend to look south of the border for technology names. Certainly the stock has performed well since about mid-2022. We're seeing a very nice pattern of higher highs and higher lows, 200-day moving averages moving higher as well. But I think once you get sort of to the valuation of the company is where we kind of stop and think twice about Shopify. Shopify is trading at 91 times forward earnings. You're getting a 30% growth rate, but that is a 3 times PEG ratio. So it's a bit pricey relative to other mega cap technology names out there. I think that margin pressures from greater transaction losses is increasing right now. And of course, Shopify is very exposed to the SMB customer, the small, medium business customer. So they tend to have higher failure rates. So there's a few concerns there that I would look at. Obviously, there's competition today and forward from names like Amazon, Salesforce, and Adobe that you want to consider.
Okay. I hope that's good for Fred. We're going to take a quick break. Stan Wong with us today. He's taking your questions on North American large caps and ETFs. Back in a moment. Welcome back. Let's go back to the phone lines for Jim, who's on the line in Oliver, BC. Hi, Jim.
Good day. Thank you for taking my call.
Go ahead.
My question to Stan is, I've started to buy some healthcare products. I own Northwest Healthcare Properties, NWH. I also bought some Middlefield, MHCD, and some Harvest, HHL. I'd like to ask Stan what his best ETF for healthcare with a dividend. Thank you very much. I'll hang up and listen.
Okay. Thank you for the question. So healthcare ETF recommendation?
When you're looking at healthcare, you're going to need to look how south of the border because there's really very limited names in Canada. You're either looking at marijuana names in Canada, or you're looking at senior living companies, which in my opinion are REITs. One name that I would consider, one ETF I would consider is IXJ in the US or XHC in Canada, depending on what currency you want to purchase. Here's a very broad-based ETF on major large cap healthcare names, Eli Lilly, Johnson & Johnson, AbbVie, United Health, and so forth. I like the space. It gives you both defensive characteristics, but you also have some growth behind it as well in certain areas of the healthcare area.
Okay, so just out of curiosity, this is sort of healthcare products and services as well, or are there insurers in this particular one?
You're going to get both. You're going to get the pharma, you're going to get the healthcare products, you're going to get the healthcare services, and then United Healthcare is in there as well.
Okay, so it's quite a mixed group, and that's
Absolutely.
The one you said it's at 70.88. It's up 24% over 5 years, so it's fairly steady.
It is. With that being said, with healthcare, you're always going to have things happening from a government perspective, especially in the U.S., in terms of how pricing is managed and so forth, which will cause a little bit of volatility.
Yeah, he's hammering the pharmaceuticals, of course, to get costs down for Americans. Okay, let's go to an email then from Eddie. He says, what are your thoughts on Maple Leaf Foods? Okay, so Maple Leaf Foods, we'll pull up that line chart, very well-known Canadian brand of processed foods and meats. They are down about, well, not much today, but they're $23.96 and up 6.5% over the year. The chart just looks a little more dramatic than it is. But what are your thoughts?
Certainly, a very volatile name for a consumer staples company. You're paying 15 times forward earnings, historical growth rate, earnings growth rate around 6 to 7%. Stock's fallen because they missed in the consumer packaged products segment recently. The stock really has been, other than the last little while, has really been very sideways over the last 5 years, a very sideways trading pattern. I think rising input costs causing margin compression is something as investors we really need to consider. So not a name we have in our portfolio. In the consumer staples space, we're pretty careful in terms of what we want to own in that area, but some of these food products wouldn't be the area that we would concentrate in.
Okay. Eddie, I hope that's good for you. Let's go to Dan. His question is about Airbnb, ABNB on the NASDAQ. A buy, sell, or a hold? Let's have a look at the Airbnb line chart and see how it's doing. I mean, it's a model that has been embraced by many people. Is this a stock you've ever owned?
We don't. I prefer a name like Expedia, which we have in our portfolio, or Booking for that matter. Airbnb, you're paying 25 times forward PE for about a 10 to 12% growth rate. But the stock really has been quite flat. I mean, the 200-day moving average has been trending lower, which is not a positive thing. The price is really locked in a sideways channel since mid-2022. I think what's happened is that growth in supply, meaning home offerings, is really stalled, or it's matured much faster than expected. And then there's regulatory risks in many different cities. Some cities say
they're introducing taxes, they're introducing a lot of regulation around it, so maybe people pull back from that.
Or you can't even have an Airbnb. So I think there are some risks with this type of name, or some things that are stalling the performance of this particular name and the earnings involved. There's more increased cancellations due to this reserve now, pay later type of platform as well. So for me, I'd rather hold something that is a bit more diversified, such as Expedia. And Expedia, as you may know, owns Vrbo, which is a competitor to Airbnb. So with Expedia, you're getting, airline travel, you're getting hotels, you're getting a Vrbo. So it's more diversified. And I think they're just run much better than most of its peers. All
right, a wider exposure there. Okay, let's move on to Frank then. He has written in and says, what are your thoughts on Alphabet, GOOG, Google, of course, which has also done fairly well. But let's take a look at the line chart today. As we mentioned, some of the tech stocks have been dragging down over valuations concerns. So let's see if Google, Alphabet is one of them. And there it is, coming up in a moment. But is this something you're invested in?
We hold Google or Alphabet. We've held it for a very long time. We've trimmed down as we kind of hit our max weighting in this name time and time again. I continue to like it. It's obviously the giant in the search engine space. AI is picking up for Alphabet as well. You're paying 26 times for about a 16% growth rate. So I think that's a very fair PEG ratio for the giant in the search space. And of course, with their other areas such as YouTube, that's performing extremely well. With some of its hardware services or hardware products, it's performing well. And really, Alphabet is really trying to envelop the consumer and have all these multiple services that are available to them. So I do like this name. I think long-term it'll continue to perform very well.
Okay, let's get to another quick email then before a break. Ian has written in to say shares of Meta have recently sold off. Do you think this would be a good entry point for a long-term hold? Meta, I think, has sold off on concerns about CapEx spending by the company the rest of the year and into next year, and perhaps overspend. Let's look at where it's pulled back to, and you can decide if it's a good entry point for a long-term hold.
Yeah, and we've heard this story before. Meta fell not that long ago, a couple of years ago, because of concerns about overspending. You're paying 20 times forward PE for about a 15% growth rate for this company. So I think that's a pretty good valuation for one of the mega cap technology names. I think that Meta is kind of being swept up in this, week or two of concerns about AI bubbles and so forth. And we've seen this story before. I think it'll bounce back. It is below the 200-day moving average, but that's happened before. It actually happened in April during the tariff sort of tantrum back then. Again, this is one of these names that long-term will perform well, obviously a higher beta type of name. But we like, if you look at this channel since 2022, it's just upwards and onwards.
Yeah, it's hard to watch because in August, I guess it was up to 790. Now it's dropped down to 608.75. So it might be a good, reasonable entry point if you're looking at that.
RSI is at 26, so indicating oversold at this point.
Okay. That is all the time we have for your phone calls and your emails. Stan's going to stick around and share new top picks. That's coming up next. Join us tomorrow for Market Call. Jerome Haas will be on the show, portfolio manager at Lightwater Partners. He'll take your questions on Canadian stocks. That's tomorrow. Let's get to new top picks from Stan Wong right now. The first one is Eli Lilly, LLY, on the New York Stock Exchange. I was just having a look at the chart. It was down to something like 625 in the summer, sort of early August, and now it's, doubled? So what's been going on with Eli Lilly?
This is just a very, very resilient name, especially when you compare it to some of the other peer groups, especially Novo Nordisk for one example. That stock has not been doing very well. I mean, Eli Lilly is a global pharma leader. They're a leading innovator in diabetes, obesity, oncology, neuroscience as well. They've got a strong pipeline, very strong, expanding global presence as well. We expect about a $76 billion revenue in 2026 for fiscal year, and earnings growth expected to be about 20% going forward. There's a lot of momentum in the metabolic and oncology space. These blockbuster diabetes and weight loss drugs are really transforming, kind of their growth profile. And oncology is something that is very strong and solid for them as well. Recently, as you may know, they had a pricing agreement with the Trump administration. That's a big tailwind. Although some of the obesity drug prices are lower because of this agreement, in exchange,
significantly lower, right?
They are lower, but what they're getting in exchange is expanded sort of coverage in Medicare access. So that broadens patient reach and supports more long-term demand, and really sort of corners the market for a name like Eli Lilly.
So they haven't quite doubled, which I want to say they're at 1,028. You would still put money in at this point?
It's a bit overbought at this point, so I'd probably wait for a little bit of softness in the stock or calm down a little bit before we get into adding to the name. But we own the name, obviously, and we'd watch, what entry point to get in. I think long-term, there are secular tailwinds, aging demographics, rising healthcare spending around the world, advances in biotechnology. These are all things that can position Lilly to continue to perform well.
Okay, let's get to your next pick, which is Goldman Sachs, GS on the New York Stock Exchange, very well-known name in the world of finance. What do you like about Goldman Sachs?
Another global powerhouse, but in the financial space. They're leading in investment banking, trading, asset management, and wealth management. They're moving a little bit away from the consumer into the more higher margin asset management and wealth management space. They oversee about $3.5 trillion in client assets under supervision. So really, it's a monster. We expect about $62 billion in 2026 fiscal for revenue. Earnings growth is expected to be around 15% growth going forward. There's a recovery in capital markets. Investment banking volumes are increasing or improving. There's renewed equity and debt issuance. And then you have lower interest rate environment and more risk appetite out there, aside from last week or so. And then there's potential policy tailwinds. When you look at this administration in the U.S., there's more likelihood for more deregulation and lower corporate taxes, which will help names like Goldman Sachs and J.P. Morgan and so forth, which is another name that we hold. 2% dividend yield. I think you're getting a nice, modest dividend yield there. You'll see more steady share buybacks for this particular name as well. And again, we like leaders in industries, and Goldman Sachs is definitely one of those.
Okay, let's get to your next new pick, which is the Taiwan Semi, TSM, on the New York Stock Exchange. Also a very well-known name in tech. Why do you like Taiwan Semi compared to some of its competitors?
I mean, this name is the backbone of the chip and the AI industry. It is the world's leading chip foundry company. They command about 70% of global market share in this space. Some of its major customers include Apple, Nvidia, AMD, Qualcomm. We see very, very strong growth forecast for this name, about 30% earnings growth. We see 2026 fiscal year about 150 billion US revenues. They have leadership in the 3 nanometer production space, and they're progressing towards 2 nanometer. And to think of how small nanometer or 1 or 2 nanometers is mind-blowing, quite honestly. And that will really sustain their partnerships with their customers. And there's, as we know, there's very strong structural demand in the space for chip usage across, whether it be electric vehicles, data centers, AI. I think that there's just long-term secular growth there. A lot of people compare the current environment to year 2000. I was around in year 2000 in doing this, and it's not the same. We have real demand today. We have real cash flow, real ROE with these companies. So it's saying that there's a bubble here is very premature, because the PE levels were much higher back in 2000 with almost no growth expected at that time.
Very quickly, who are their competitors?
There's not many, actually. Yeah. There really isn't at the space, because their market share has been growing over the years. 70% today, and not too long ago was 50%. So, and they're expanding. There's more fabrication plants being built in the U.S., Japan, and the Eurozone. So that enhances that supply chain security for TSM.
Okay. Got to leave it there, Stan. Thanks for joining us. Appreciate seeing you in. And thank you for joining us today on Market Call. We'll see you back here again tomorrow.